Now speaking, Katie Turlington, Investor Relations. AGNC Investment Corporation held its second quarter 2023 earnings call. The company provided a safe harbor statement that all forward-looking statements are subject to change without notice and certain factors could cause actual results to differ materially from those contained in the forward-looking statements. Participants on the call included Peter Federico, Director, President, and Chief Executive Officer, Bernie Bell, Executive Vice President and Chief Financial Officer, Chris Cole, Executive Vice President and Chief Investment Officer, Aaron Pa, Senior Vice President, Non-Agency Portfolio Management, and Sean Reed, Executive Vice President, Strategy and Corporate Development. The company discussed its financial performance for the quarter, including new initiatives and major announcements. Now speaking, Peter Federico, Director, President, and Chief Executive Officer. The second quarter of 2019 provided a favorable investment outlook for Agency MBS, with historically attractive asset valuations, strong funding markets, and gradually improving hedging conditions as the Fed ends its monetary policy tightening campaign. Macroeconomic factors, such as debt ceiling uncertainty and the possibility of a government default, weighed heavily on Agency MBS performance and pushed spreads to the widest level since the Great Financial Crisis. At current valuation levels, Agency MBS look extremely attractive on a standalone basis and provide investors a compelling alternative to U.S. Treasuries, with a spread to the 10-year Treasury of about 175 basis points and a yield of 5.5%. Agency MBS also look compelling relative to investment-grade corporate debt, with a spread differential of positive 15 basis points, which is about 90 basis points cheap to the historical average. The short-term funding markets for Agency MBS and U.S. Treasuries remained strong in the second quarter, despite debt ceiling concerns. Interest rate volatility has also declined from the highs of last year and will undoubtedly decline further once the Fed reaches its desired short-term rate level. AGNC's levered portfolio of Agency MBS and hedges is fully marked to market and can generate mid to upper teen returns on a go-forward basis, either through strong earnings or a combination of favorable earnings and net book value appreciation. Now speaking, Bernie Bell, Executive Vice President, Chief Financial Officer. Thank you, Peter. AGNC had comprehensive income of 32 cents per share for the second quarter, with economic return on tangible common equity at 3.6%. Tangible net book value decreased slightly by 2 cents per share and 36 cents of dividends were declared per common share. Leverage was maintained at 7.2 times tangible equity, while average leverage decreased from 7.7 times for the first quarter to 7.2 times. AGNC issued $106 million of common equity through an at-the-market offering program at a premium price to book. Cash and unencumbered Agency MBS totaled $4.3 billion or 58% of tangible equity and $80 million of unencumbered credit securities. Net spread in dollar roll income, excluding catch-up amortization, was 67 cents per share for the quarter, a decline of 3 cents per share due to a smaller asset base. Net interest spread increased to 3.26% for the second quarter, compared to 2.88% for the prior quarter. Average projected life CPR on the portfolio at the end of the quarter was largely unchanged at 9.8%, with actual CPRs for the quarter averaging 6.6%, compared to 5.2% for the prior quarter. Now speaking, Chris Cole, Executive Vice President, Chief Investment Officer. The second quarter of the agency market faced several major headwinds, including a supply shock following the second largest bank failure in U.S. history, a debt ceiling standoff that risked triggering a U.S. debt default and a further repricing of market expectations for tighter Fed monetary policy. Despite the volatility early in the quarter, there are a number of reasons for optimism. Interest rate volatility is likely to decline, the stresses in the regional banking system have largely abated, the SVB liquidation has gone better than expected, and the supply of Agency MBS over the remainder of the year is expected to be very manageable. AGNC added approximately $2 billion in Agency MBS during the quarter, bringing their portfolio to $58 billion as of June 30th. They also increased their higher coupon holdings by approximately $5 billion and the weighted average coupon of the portfolio increased approximately 19 basis points during the quarter. Their hedge portfolio totaled $61.2 billion as of June 30th and their duration gap was 0.4 years. With the debt ceiling standoff behind us and greater confidence that we are near the inflection point of this Fed policy cycle, AGNC expects the second half of the year to be an attractive earnings environment for Agency MBS. Now speaking, Aaron Pa, Senior Vice President, Non-Agency Portfolio Management. During the second quarter, both AAA and credit spreads generally performed well, tightening modestly by quarter end. Technical factors such as limited housing supply driven by elevated primary mortgage rates have caused both purchase and refinance origination volumes to remain low. This has resulted in existing borrowers with deep out-of-the-money mortgages being effectively locked into their current mortgages, reducing housing inventory and depressing home sales data. Lower overall levels of housing activity drive lower mortgage issuance volume and are also supportive of house prices given limited supply, providing a favorable technical backdrop for mortgage credit. Additionally, the fundamental picture has improved modestly as expectations increase for a soft landing in light of encouraging signs seen in recent inflation readings, firming house prices and a resilient employment landscape. The technical backdrop within the credit risk transfer market has driven strong outperformance due to a decline in MBS issuance and tender offers and paydowns, reducing CRT float, resulting in a decline of approximately 8% over the last year. Our non-agency portfolio ended the quarter at just over $1 billion, a decline of approximately $250 million from March 31st. We continue to reduce our MBS position while also opportunistically selling some CRT securities and rotating further down the capital structure. Lastly, repo market spreads for non-agency securities were largely unchanged on the quarter, with the bias toward being slightly wider. Credit Suisse analyst Douglas Harder inquired, "Could you please discuss your views on the dividend in light of current returns and the upcoming maturity of your legacy swaps?" Peter Federico replied, "Thanks for the question, Doug. Our net interest margin this quarter was an all-time high of 326 basis points, but that's not reflective of the true economic earnings of the portfolio. If we look at the portfolio on a mark-to-market basis, with a mix of 5- and 10-year swap and Treasury hedges, the net interest margin is likely around 175 to 180 basis points. Leverage 7.5 times, with our operating expense of 1%, this should result in an economic return on the portfolio in the high teens. Our dividend yield on book value is currently 15%, which is in line with the economic earnings of the portfolio. We expect some compression as short-term swaps roll off over the next year, but this should bring the net interest margin more in line with our dividend. We're comfortable with where it is and we think they line up well from an economics perspective." JMP Securities analyst Trevor Cranston inquired, "Could you discuss the potential impact of the FDIC portfolio sales on MBS market volatility?" Peter Federico replied, "Yes, absolutely. I think the key takeaway here is that we are seeing a lot of positive signs in the market and we are optimistic about the outlook. We believe that the Fed's balance sheet runoff and the regional banking crisis being in the rearview mirror are both positive developments that will help to stabilize the market. Additionally, the inflation data over the next couple of months will be key to determining the direction of mortgage performance." Chris Cole replied, "The FDIC's liquidation of Signature Bank and SVB caused a supply shock in the market, resulting in wider spreads. When the process is complete, market technicals should improve significantly. This should be further aided by slower housing seasonals, which will reduce organic issuance. Of the $83 billion of agency MBS that had to be liquidated, only $13 billion pass-throughs and $10 billion CMOs remain. The process has gone better than expected, likely due to strong inflows into index-based fixed income managed funds." JMP Securities analyst Trevor Cranston inquired, "Can you provide an overview of the coupon stack you are adding to the portfolio? Are you focusing on 6s and higher?" Chris Cole replied, "Relative value across the mortgage stack is still very much upward sloping, given current valuations. This is due to index-based investors driving demand for low coupons or index coupons that aren't being produced outside of FDIC liquidation. Low coupon float is locked up at the Fed and banks, meaning there are few true arbiters of value and all the supply is in production coupons." Keefe, Bruyette and Woods analyst Bose George inquired, "What is your view on normalized longer-term leverage?" Peter Federico replied, "In response to your question, Bose, our leverage outlook is dependent on the environment. We've been operating with a defensive position for 8 quarters, but in the second quarter we saw the first change in that trajectory with an increase in our asset balance. Our current leverage is now higher than it was at the end of the last quarter, and we have a lot of capacity to take leverage higher as the market conditions continue to unfold. We have a significant amount of unencumbered cash and mortgage-backed securities, and we're continuing to add mortgages in this environment." Keefe, Bruyette and Woods analyst Bose George inquired, "Given the efficiency of your ATM issuances, will that be the way you issue capital going forward?" Peter Federico replied, "The ATM program is an efficient and cost-effective way to raise capital. We recently raised $100 million in a manner that was accretive to our existing shareholders' book value. We will continue to be disciplined and opportunistic with our capital raises, always considering our existing shareholders first. The ATM program gives us the flexibility to do this quickly and cost-effectively." JP Morgan Chase & Company analyst Rich Shane inquired, "What drives the nonlinearity and asymmetry in interest rate sensitivity on page 25? Peter Federico replied, "The duration gap sensitivity on page 11 of the investor presentation shows that from a rate perspective, we are above the peak convexity point in the mortgage universe. This means that it would take a 200 basis point rally for only about 20% of the universe to be refinanced. We have more down rate risk, meaning our duration will move quicker in a down rate scenario than it will in an upright scenario. That's why we continue to operate with a small positive duration gap, which hurt our performance in the second quarter when rates were rising. In the current environment, there's more two-way rate risk and our portfolio is more sensitive to a falling rate scenario. We'll likely continue to operate with a small positive duration gap, as seen in the sensitivity table. J.P. Morgan Chase & Company analyst Rich Shane inquired, Peter, what is your strategy for increasing leverage and how will it affect the duration of the portfolio? Peter Federico replied, I appreciate your summary of the three key variables. Leverage has already been discussed, so I'll address the other two. With regards to the duration gap, in the current environment, with an inverted yield curve, having a positive duration gap is actually a negative carry on the portfolio. This equates to a 1% drag on ROE. Therefore, we will likely keep our duration gap low. When the yield curve is positively sloped again, a positive duration gap may be profitable from an ROE perspective. Regarding the hedge ratio, we have operated with a very high hedge ratio, meaning all of our short-term debt was essentially termed out into synthetically longer-term debt. Our hedge ratio is currently at 119%. As swaps roll off in our portfolio, our hedge ratio will likely decrease, potentially well under 100%. This could be a source of earnings potential. Additionally, our assets are still 100 to 120 basis points below market yields, which will also change over time as we roll out of old assets into new assets and hedges roll off. UBS analyst Vilas Abraham inquired, Peter, could you provide some insight into net supply expectations and how they may affect spreads over the next few quarters? Peter Federico replied, in response to the question, I believe that the agency MBS market should perform well in the second half of the year. The net supply of mortgages is expected to be around $200 million, and the Fed's runoff is estimated to be another $200 billion. This means that the private sector will need to absorb about $400 billion worth of mortgages, which is manageable. Additionally, the peak cyclical point for the housing market has passed, and mortgage rates and affordability should keep mortgage supply contained. Furthermore, the rotation of money into fixed income investments, particularly agency MBS, due to their relative cheapness compared to Treasuries and investment-grade debt, should draw more money into the market. All of these factors should lead to a positive outlook for the agency MBS market in the second half of the year. UBS analyst Vilas Abraham inquired, could you explain the performance dispersion across the coupon stack? Peter Federico replied, in the second quarter, we saw steady bond fund inflows, which drove up the price of the index. This resulted in outperformance of the lower coupons due to the fixed income demand and lack of supply. The higher coupons offered better carry, but the performance differences were more muted. UBS analyst Vilas Abraham inquired, could you provide an update on the book value as of the end of the quarter? Peter Federico replied, Bernie mentioned that it was roughly unchanged on the quarter so far. DIG analyst Eric Hagen inquired, what drove the divergence between swap performance and Treasuries last quarter, and how will it affect hedging going forward? How might new bank regulations and a potential shift in banks' mortgage finance footprints affect MBS performance in the secondary market? Peter Federico replied, sure, with respect to hedge performance, we saw differences between swap hedges and Treasury hedges due to the volatile market. We've shifted our hedge mix to include more long-term hedges, such as 5- and 10-year Treasuries, which should benefit us in the long run. With respect to bank capital, it could be a multi-year issue that could lead to a substitution effect of banks moving from Treasuries to higher-yielding agency MBS. Piper Sandler analyst Crispin Love inquired, what are the key drivers of the agency MBS spread relative to investment-grade corporates? Peter Federico replied, the current environment is rare in that agency mortgage-backed securities, MBS, are trading at a much cheaper rate than investment-grade corporates. This is due to the explicit backing of the U.S. government for GSEs, as well as interest rate volatility and the fact that agency MBS are short of all their liquid and spread products. When investors have to liquidate, they liquidate what is liquid, making agency MBS the security of choice. Despite being the second most liquid market in the world, it is difficult for retail investors to access agency MBS, making them mispriced relative to corporate bonds. Peter Federico replied, thank you for joining us on the call today. We have been through a challenging period of repricing in the fixed income markets, but we believe we are nearing the end of this process. We anticipate a very favorable investment environment in the near future and look forward to updating you at the end of the third quarter. Thank you for your time.